Increased competition in the banking sector is expected to cause cross-movement by borrowers shopping for loans on competitive terms. But what should a borrower know before moving their current loan from Bank A to Bank B? Before one can make that move, it's important to begin with a comparison of the overall interest rate on offer. The recently launched annual percentage rate, which provides the total annual cost of repaying a loan in percentage terms, is a good place to begin from in comparing what each bank is charging for its loans.
With one rate that is being given for your loan at the beginning, so that you don't have to be surprised that indeed my account has been debited with larger fees, with commissions, renewal fees, because all those things add up to costs of credit.
But it doesn't end there. Transferring a loan from one bank to another means that a borrower is effectively entering a new contract with a new bank. One must therefore read and understand the terms and conditions attached to the new loan before entering into the new contract, as Mwangi Karume, a banking law expert, explains.
I've heard certain banks saying that, okay, just move your mortgage, we'll take care of the rest, meaning that, all the costs that I've mentioned, the valuation fees, the legal fees, the facility fee, and all that, the bank will take care of that. There's always an asterisk saying terms and conditions apply.
Secondly, consider the fees associated with a new loan, which include the processing fee, insurance fee, legal charges, valuation fee, and other allied charges that the prospective new lender would charge. How they compare with the charges imposed by your current lender could either make you better off or worse off.
If you're paying what you call a processing fee or a facility fee to the bank to which you are moving the mortgage to, will range between depending on the bank, 0.5 all the way to 1%.
I will encourage that borrowers do actually shop around. Just like we do window shopping when you're going to buy your suits. If you're going to borrow, there are 43 banks out here.
And one more thing. Some banks may penalize you for transferring your loan to another bank, with penalties ranging from a demand for a notice period or that a borrower pays in lieu of notice.
The already existing documents you have signed with the existing bank, the one that has the mortgage, may contain certain terms and conditions that may be prohibitive as far as moving of that mortgage is concerned.
And just in case you thought defaulting on a loan is an option to take to get a cheaper loan, you're mistaken, as this is the surest way of attracting higher lending rates in the future. This is because most banks have for the last 5 years been sharing the customers' credit histories, meaning lower interest rates only go to the most faithful of borrowers. The bottom line, though, is that one should never fall for a lower interest rate or benefit that's slightly better. After all, banks are in the business of lending. Belagenga Citizen Business Center.